All right, why don't we get started? Fantastic. Thanks again for everyone for joining. My name is Jim Brady. I'm the Senior Director of Sales for Henry Schein Financial Services. And on behalf of our entire team, thank you very much for joining us this evening as we continue to provide you content around the all-important topic of year-end tax planning as part of our Henry Schein Dental Business Institute webinar series. Just as a quick reminder, this webinar does not qualify for CE credits. I'm joined tonight by Jerry Hose. Jerry is a partner at Gray-Pilgrim and Associates. Gray-Pilgrim, as many of you probably know, is a founding member of the Academy of Dental CPAs. Jerry will be talking more about why that's so important. Tonight, Jerry's going to spend some time discussing 2023 tax planning, specifically how to optimize kind of all important Section 179 deduction as you evaluate what equipment and technology to install prior to the end of the year. We're going to learn a little bit more about the kind of often confused distinction between bonus depreciation and Section 179. Jerry's going to dive in a little bit about cost segregation studies, and then lastly provide some important information on the Employee Reduction Tax Credit, or ERC, which I'm sure many of you on the line have been approached about or received some solicitation on. So I want to make sure you're all aware of what that is and what to look out for. So without further ado, over to you, Jerry. Look forward to hearing all about the tax planning webinar tonight.
So really what we're going to talk about this evening is the tax effects of equipment purchases, understanding, when do I buy that new equipment, how that equipment can ultimately help us save money in taxes. And basically a disclosure, Henry Schein Incorporated, Henry Schein Financial Services, or Henry Schein, does not provide tax advice. Please check with your personal advisors. And who am I? I'm a member of the ADCPA, partner of Gray-Pilgrim Associate, dental accountant, enrolled agent, MBA, served 8 years in the Air Force, and served in Desert Storm. As he said, my name's Jerry Hose. Who am I really? Like my fast BMWs, love playing golf, and love my Pittsburgh Steelers. Now, what is the ADCPA? Basically, the ADCPA are dental accountants specifically for dentists, and they can help you with some of these tax planning tools and help you get the best tax deductions out there. And we're all over the United States. Certainly, there's a member probably close to you. And what you do is you just reach out to those members to the www.adcpa.org. Most CPRs are general practitioners. Not only do they understand dental, but ultimately they don't understand the daily lives of the dental society. So what you want is you want an ADCPA member that can help you ultimately understand what's out there for dentists and advocate with you for you through the ADA as well. So most ADCPA members out there all know the same things because we actually collaborate every 6 months together, and we try to keep each other abreast on what we're doing in the standards for dental accountants. Should I select 179 accelerated or bonus depreciation for my purchases this year? And that's a decision you have to make with your tax accountant. Certainly 179 accelerated depreciation or bonus depreciation are two separate things, and you need to decide which one works for you, and we'll discuss that in a minute. And then basically your estimated taxes for 2023. Purchasing equipment in 2023 before the end of the year will ultimately help maybe reduce those taxes you owe at the end of the year, and also potentially help you in 2024 as well. And other planning tips and time, we'll have time for questions as well. How does purchasing dental equipment help to reduce taxes? That's the thing. How do we reduce taxes, but we make good business decisions to do that, and we don't lose money in the process? So Section 179 and bonus depreciation. So in 2023, Section 179 is limited to $1,160,000. It's spending cap of $2.8 million for 2023. Bonus depreciation, however, you can use 80% of that depreciation, and it's unlimited for 2023. So you could buy $3 million worth of equipment and ultimately write off $2.4 million in year one, because you get that 80% deduction of that amount. So, if you buy $5 million, same thing, you get the 80%. The deduction works for new or used equipment. Certainly, if you go out there and you find a piece of equipment from another dentist, put it in service, as long as it's plugged in and being used before 2024. You can't go out there and get it financed and say, I'll have it in service on February 1st of 2024. That deduction wouldn't qualify because it's not placed in service before 2023. And there again, you must pay for it, finance before 1/1/2024. There's certainly benefits out there to going out and buying that equipment and not having to pay for it for 2-3 months or having 0% interest. Again, you can use that to your advantage because I'm going to owe taxes. So what do I want to do to reduce that tax is I need a $150,000 piece of equipment. So I buy that piece of equipment now, get it in service before the end of 2024, and my account will help me get a reduction in my taxes. And we'll show you that in a minute as well. Just having the invoice dated for 1/1/2024 is not sufficient, as I mentioned. And then the one thing that I want to mention was on the last slide as well, is understanding that states may or may not follow the federal government's depreciation schedule. So, for instance, 179 depreciation, you can write off 100% of that equipment potentially, but some states limit that to $25,000. So keep that in mind. Just because you're getting it on federal, you may not get it with your state. Like I said, you want to go out there, you buy a piece of equipment, you buy that $150,000 laser, you put it in service. It's operational before the end of the year. How does that benefit me now? So, you look at this scenario, basically I get that. I don't have to make any loan payments potentially till 2024. And that was based off of 2023's options that was out there. But ultimately, the vendor, Henry Schein, was ultimately allowing people to get that equipment and not have to pay for it for a couple months. So what we did is there was no loan payments through April 30th. The reduction or refund in taxes for 2023 then on that $150,000 piece of equipment was $45,000. Reduction in required estimated payments for 2024 is $10,000. And so really the net initial cash cost, you got $55,000 in that back because you didn't have to pay the IRS that month. So it's really big if you use this. You don't want to go out and fill a warehouse full of equipment, spend $3-4 million worth of equipment to set it there for a tax break with the government. Because remember, you're out of the money up front paying for that equipment and you're only saving 30% tax. However, if you're in need of equipment and you say, hey, I may not want it this year, I may want it next year, you kind of look at that. So there's a phase out of bonus depreciation starting this year in 2023. It's actually goes down to 80%. 2024, it goes down to 60%. 2025, it goes to 40%. And then 2026, it goes to 20% for that bonus depreciation. And then we roll back really to the 179 depreciation. So you're limited then on that 179. So, if you say, hey, I'm going to buy a piece of equipment next year, it may be tax, for tax planning purposes, it may be smart to buy that this year. And basically the effects of required tax payments for 2024. If you make over $150,000, you have to pay 90% of the tax for the current year or 110% of that tax shown on the return for the prior year. So lowering those tax payments in 2023 by buying that piece of equipment can ultimately reduce what you have to pay that first quarter of 2024. And by doing that tax planning, again, you're going to increase your cash flow until you're ready to make those payments on that. You're getting some of that money back. So lowering your 2023 tax liability by $45,000 enables you to postpone paying at least another $40,000 until 4/15/2024. So it's really it benefits 2 years potentially putting that equipment into operation before the end of the year. These benefits are examples of LLCs and sole proprietors. What about an S corporation, for instance? How does it function? Things you keep in mind is how much in W-2 income do I have? How much income do I have for the corporation? Again, you want to get those AGI limits. You want to buy that equipment maybe to reduce that S corp income, and ultimately have your accountant be smart enough to reduce that W-2 before the end of the year. And then you want to try to reduce the federal taxes you're paying on that W-2 as well. C corporations can also benefit, but it takes a little bit more planning because remember, you're trying to zero out your income in a C corporation. So again, you want to look at that W-2 before the end of the year, reduce that W-2 because it'll keep you inside that QBI deductions and also the limitations on for QBI, which we're going to get into in a second. So qualified business income deduction, if you're operating a business as sole proprietor, partnership, or S corporation, you're a non-W-2 income. From these business entities, you could qualify for 20% reduction of income. So what that says is I made $100,000 before I pay taxes. I get a 20% reduction. So that now goes down to $80,000 I pay tax on. So planning that out, even as higher earners, but buying that new equipment, putting it in place before the end of the year, which we'll get into in a second, is really what you're trying to do is get that income limits down inside the QBI deduction. So two things, you can reduce your taxes for buying that new piece of equipment and also reduce your income by 20% potentially by the QBI deduction. But be sure to balance that W-2 wages and the S Corp K-1 income. Certainly what the IRS says for dentists is your income should be about $250,000. And that's their guideline. So as long as your income hits around 250, that corporation could have $250,000, $300,000 of income. But if you're trying to get this QBI, what we're trying to do is reduce that taxable income on the W-2s, maybe to say 200,000, because we'll eliminate that S Corp income to zero if we buy equipment. Be sure to plan year-end profits to be below those AGI limits. Kind of example of that, the QBI and the Section 179 bonus depreciation is in 2023, my income's $470,000 without 179. My standard itemized deduction then will be the $29,000. So I have zero QBI deduction because my income limits are above, you'll see below there, $182,000 for a single filer or $364,000 for the joint filers. So because I'm over that, I don't get that QBI tax deduction. So then my federal taxes are $103,000 on my $441,000. However, if we use that Section 179 depreciation and we can get that income from the practice to $320,000, and then I can get my adjustments for my standard deductions on my tax return up to $29,000, and I get that QBI deduction of $64,000 for that 20% deduction of income. Now my taxable income is $227,000. So ultimately, you're saving $200,000 of tax or income. You're reducing your income by $200,000. You're turning around and turning that into a $61,000 tax savings because of that $150,000 piece of equipment that also got you under the QBI. The tax effect there is 41% reduction of tax. When you take that $150,000 rather of a piece of equipment and you take the $61,000 off, really you're paying 41% for that piece of equipment. Or I should say 60% for the equipment. Another consideration is, I have the 179, I have the bonus depreciation, I can use that. Well, you also get to use that potentially with your cost segregation studies. So you say, I don't need any new equipment this year, but hey, I've been leasing this building, I'm ready to buy a new building, is this the time? So what you do is you ultimately go into that new space and you start the build out. Basically, a cost segregation study is going to tell you how much stuff you can write off, and it's going to allocate it based off the years you can depreciate that. Really what they're saying is everything outside from the walls out and the land, you're not really depreciating. That's going to be 39-year for the structure, and then the land's never depreciated. So really what you're doing is everything is inside of that building. Ultimately, you could write off potentially within year one if you use bonus depreciation or 179 for some of these assets. And I'll get into that in a second as well. And then don't forget that you can deduct the balance of unamortized leasehold improvements. You certainly move out of a building when you're doing this. You say, but I built this building out, even though I'm leasing it, I paid all this money. Do I lose that? No, you get to write that off as a loss as well, because you ultimately paid for those leasehold improvements and then walked away from them. How to turn the studs and drywall into Section 179 eligible expense. The benefits of a cost segregation study. So you have $1 million in building cost equals $400,000 in tax aid. Without the cost segregation, straight line depreciation, for instance, you do it over 40 years, you get $25,000. So you save $10,000. With the cost segregation study, you can get 20% of that cost in 5 years, which is $200,000, 1% in 7 years, which is $10,000. Then you get the other 8% in 15 years, and then the rest of that building is 39 years. So as you can see, you're basically bringing an additional $80,000 additional tax savings in the first 5 years. Here's the example of how a cost segregation study would come across. So what they do is they take that $1 million building. There on the left side in the green at the top, you're going to see the percentages. And they said, okay, the 39-year property, which is the land and the structure, that's just the structure, not the land, is $710,000. The rest of the property is 5 years, 7 years of 15. And what qualifies as 5 or 7 or 15 is because we did that leasehold improvements on the inside for our business to be able to operate. And then the cost segregation gets put in effect, and you can actually save this money. As you can see here to the right, the present value at the bottom, in year one, without the tax segregation, or the cost segregation, your depreciation study, your annual depreciation would be $12,000. With the cost segregation in the middle there, you would actually save $54,000 of taxable income in year one. So that's a $41,000 reduction, which allocates to about $16,000 of tax savings. And that's going to be more cash flow into the practice or in your pocket because you're using the cost segregation to your benefit. And you can see the present values there as well. Basically, in year one, you save the 16. After the first 6 years, you're saving 69,000. And then the 40-year life, you're saving 58,000. And then here's if you own a 500,000 in tenant improvements, you can also do that as well. I leased the property. I want to do the build outs. Can we do the cost segregation? Absolutely. They still can go through, do the cost segregation, and ultimately give you those improvements of 500. You can also get those improvements allocated as well. What do you really need to know? Ultimately, what you really need to know here is, what am I saving in year 1, 7, 15, 39, and what am I getting to write off? So as you can see with that 5-year property, if we use bonus depreciation, that's potentially $200,000 you can write off in year 1 if you want. The same thing can be said for the 7-year property. You can put that in year 1 as well. You could also ultimately do the 15-year property as well if you use the bonus depreciation or the 179 as well. Examples of qualified components. The light switch. Hey, I have to put a light switch in, and the reason I have to put a switch in, and the reason I had to put that receptacle in is because I want to put an X-ray machine there. Because of that, you put that there for that operational piece of machine for you to be able to perform services all day. So that's actually a tax write-off, and it can be a qualified piece of equipment that can be written off in 5, 7, or 15 years. Is this a building or equipment? Is this building or equipment? Ultimately, your lights, hey, I had to have a light there so we could see for the X-ray machine. Again, how they determine is that had to be there to perform your duties. Because of that, again, it can be written off in a 5, 7, or 15 year period. So basically here you'll have the schematics. Everything in there in the middle is basically everything you're going to write off in 5, 7, 3 years, 15 years, whatever that is. You're going to get to write that off for a cost segregation study, because most everything in there was for you to perform your services for patients and for you to do your daily job. What doesn't qualify? Really just the structure for the building, everything on the inside. such as putting those ops in or whatever you have to do, the office suites, you get to write all that off potentially again through the cost segregation study. And ultimately, you can get a big deduction in year 1, 2, or 3. As I mentioned earlier, land never qualifies because the thought process here is certainly land's always going to appreciate. So when you sell that land, you're ultimately going to make more money. So there's no depreciation to that land. However, the building certainly deteriorates all that. So that's why they depreciate it. Timing your cost segregation study too is very, very important. A lot of people, they'll go out without the right advice from their accountant. They'll run out, they'll buy, they'll build a new building. They'll get $500,000 to $1 million worth of equipment, and they'll do the cost segregation study. They'll do the equipment, and then they find out, hey, I've zeroed out my income. Well, I've zeroed out my income, so for the next 5 to 7 years, I don't have any write-offs anymore. So when my income goes to $1 million, $2 million, $3 million, it reduces how much I can ultimately write off against that income, so I pay more tax. So what you want to do is sit down with your tax advisor and make sure you use that depreciation to benefit you in year 1. That's why you do the cost segregation study and you buy the equipment. But you also want to work with them and say, is this a good year to do the cost segregation? You can go back 10 years from now and do a cost segregation study. So if I have equipment this year for that new building and I pay $500,000 to $1 million for that equipment, that's probably going to give me enough write-offs to put me in the 10, 12, or 22% tax bracket, or 24% tax bracket. So what I want to do then is I want to go out then and apply that cost segregation study next year or the year after, because then I get a deduction in years 2, 3, 4, 5, ultimately with the cost segregation study as well. But as a dentist, for dental equipment, for instance, most dental equipment is depreciated over 5 years. So if I have $500,000 on equipment and I depreciate that over 5 years, that's a $100,000 deduction to my income that I get every year for 5 years if I don't take 179. So keep in mind, it's not always necessary to take the 179 if you want to get on a more steady income level and know what your taxes are every year. You ultimately want to use these tools to ultimately keep your taxes lower for several years, not just one. Basically, the key takeaways here is that the tax planning is complicated. Don't wait until next April to start. New equipment purchase can have a big impact on the tax liability. Choose wisely before you automatically take accelerated depreciation, as I mentioned. Basically, encourage anyone that doesn't understand these rules. If you've asked your accountants and they don't understand it, you want to talk to an ADCPA member. They're going to help you benefit from timing of the cost segregation study, buying the new equipment, reduction. You want to talk to the Henry Schein, for instance. They have a lot of times they'll have really good deals at the end of the year, potentially lower interest rates than you'll find anywhere else. Ultimately, again, talk to your rep and plan that timing out for buying that new equipment. Before I get into questions, I got done a little early on purpose, to be honest. We'll come back to that in a second. I just wanted to touch on a couple other things we found was very important. We want to talk about the fact that you want to be careful when there's buying ads like this. The COVID and all that, the ERTC credits, it's a really big thing right now, and the IRS wants you to be aware. These refund mills are ultimately out there, and what they're offering people $200,000, $300,000, $400,000 of tax credits. And remember, in 3 years when this is all going away, they're going to go out of business because they've made all their money. They're going to leave you holding the bill, and then you're going to have to take that up with the IRS. The other thing is beware of the third parties promoting the ERTC. IRS shuts the door on the new pandemic tax credit claims until at least 2024. Basically, here again, the ERTC is refundable tax credit designed for businesses who continue paying employees while shut down due to COVID pandemic. It's not where people are getting paid for money while their employees were sitting home on unemployment and all those things. And if income went up, they can't go back and reduce your income to make you qualify. And they're finding out they're using tactics such as using restaurant things that qualified a restaurant or a bar or something like that, they were using those tactics to get people to refund. Example of those government mandates being required to shut down. Here, you'll ultimately have the states, they'll give you the dates you were shut down. If you weren't shut down, you don't qualify for it. And again, the reduction of income is the other thing you're looking for here. And then, recovery of startup business based on American Rescue Plan Act, a business that opened during the COVID pandemic may qualify to receive the credit. Really, and here's the thing, started a business on or after February 15, 2020, annual gross receipts don't exceed $1 million, and you employ one or more employees. What can I claim? 50% of all qualified wages you paid for employees from those dates. There's a limit of $10,000 in wages per employee. So you'll hear the age-old thing, hey, I'm going to get $26,000 per employee. That's not always the case. Just dive into it before you sign on to these. I think that's all I have. Ready for questions.
It was wonderful. Thank you so much, Jerry. And we'd love to invite our audience to please come in and enter their questions in the chat, in the Q&A box. I know that there was a lot of information there and that there must be some really good questions that are bubbling up. So we invite you to please bring them into the Q&A box at the bottom of your screen. And in the meantime, while we wait for those questions to come in, Jerry, are there any frequently asked questions that you've gotten even just recently that you can share with us?
People come to me and then a lot of times we're getting the question, is it good time to buy equipment? Again, with the 80% reduction to equipment, I advise my clients to buy the equipment if they're going to buy it in the next year or two, because they're going to get a bigger deduction today. But what they don't want to do is buy equipment that's going to sit around and be duplicated just to save the tax dollars.
That makes sense. In terms of the tax terms, what are some tax terms that people should really sort of keep at the front of their mind when considering
For the equipment?
Mm-hmm.
Yeah, like I said, as far as tax terms, you're looking at 179 depreciation, bonus depreciation. Ultimately, what they're really wanting to look at is talk to their tax person and say, what am I going to save this year, but how much am I going to save next year? So as far as the taxes go, reduction of taxes can happen in multiple years. You don't want to take it all in 1 year and actually be at a 10% tax bracket, pay no taxes this year, but then have to pay a lot next year. So the terms you want to look at is you ultimately want to find out what tax bracket this is going to put you in, and then for how long. Can I string this out for 3 or 4 or 5 years instead of being in a 39% tax bracket?
Fantastic. Well, thank you everyone for joining this evening. I've also put, or will be shared in the chat, a link to an ebook that has been published by Henry Schein, in which Gray-Pilgrim is prominently featured. So feel free to download that ebook as well. As we've mentioned, these slides will be circulated, and also they'll be available on YouTube in the future. So feel free to reach out directly to Jerry or myself. Thank you everyone for joining this evening.